Hello, everybody, and welcome to today's episode. And in today's video, I'm just going to talk about how to know if your strategy actually works without overfitting. Why? Because most of the traders don't know if their strategies work. They believe it works until the market proves otherwise. And I believe is actually expensive in trading. And the reason why, with my interaction with a lot of traders, the common question that arises is that which is the best strategy that I can be able to use, right? And that's quite a very honest question. But again, I believe from this particular video, you're going to get the answers to that particular question. So one thing that you need to understand is that backtesting actually looks amazing. Demol account looks very clean when you're trading in Demol. There is no much losses, okay? And during even backtesting, you realize that you'll be able to see all those particular setups. But when it comes to live trading, this one tells a different story. So the problem isn't that strategies don't work. It's that the trader mistakes curve fitting for age. What do I mean? So keep up to the end, and you are going to understand what I mean by that particular statement. That the problem isn't that strategies don't work, it's that the traders mistake curve fitting for hedge. Okay, so in this video I'll show you how to know if your strategy actually works without overfitting yourself into false confidence. So this video is for traders who keep tweaking strategies after losses, have great backtest but poor live results, aren't sure whether to trust their system, and feel stuck between keep going and start over. So if you've ever asked yourself, is it me or is it my strategy bad? This video is for you. Okay, so and here is the truth that you need to understand. A strategy does not need to win often to work. It needs to win consistently over time. And the reason why, you'll understand that your strategy, using a strategy, you can be able to win like 70%. You can be able to lose 40% and win. You can be able to lose 60% and win 40%, and you are still profitable in the long run. Again, if you implement the aspect of risk to reward ratio, right? So what you need to understand is that short-term performance actually will give you false results, or it tends to lie. But long-term behavior is the one that tells true when it comes into trading. And the reason why, if you want to really know or understand your hedge in trading, you don't need to look at your first 5 trades that you have executed. No, you need to look at least the first 100 trades that you have executed. That's what's going to tell you or show you whether you have an edge in trading. Okay, so and what I'm going to discuss here is basically the first thing that I'll begin looking at is what working in quotes actually means, what traders means, or what it means when traders say maybe probably a working strategy. And you realize that most traders define a working strategy as a high win rate, a smooth equity curve, or constant profits. And that's fantasy, because you realize that, like we have said, no strategy that is going to win 100%. You're never gonna have a smooth equity curve, because there are some instances whereby you'll be making some losses. There are no constant profits when it comes to trading, because sometimes you might have some losses, sometimes you might have profits, etc., etc. So the reason why I'm saying that all this definition of a working strategy, high win rate, smooth equity curve, constant profits, that's all fantasy. A real working strategy has periods of drawdown, right? And get that right, streaks of losses, uneven performance, and emotional pressure. Okay, because you'll definitely have those instances of drawdown. You'll definitely encounter streaks of losing trades, uneven performance. You'll have emotions, right? When you're trading, your strategy will give you emotions, because working doesn't mean perfect. Okay, but most of the traders want to get perfect results, and there is no perfect result. There is no trader who can be able to win 100%. Working basically here in this situation means positive expectancy. Okay, it means positive expectancy. So if you don't understand expectancy, you'll constantly abandon good systems. And here is the overfitting trap. Overfitting happens when you add rules to avoid recent losses, tweak indicators to fit past data, optimize parameters for perfect backtest, and constantly refine after drawdowns. The result of this, a strategy that works in hindsight and fails in live markets. So it works in hindsight, but it fails in live markets. Overfitting basically creates false confidence, fragile systems, and performance collapse under new conditions. And therefore, a strong strategy survives variation. A fragile strategy needs a perfection. Okay. So, because we have been in this situation whereby we find ourselves maybe after a streak of losses, you don't even trust your strategy, so you start adding rules basically to avoid losses. You start tweaking indicators to fit past data. All right, so you constantly refine after drawdowns. All right, so the reason why you need to understand that a strong strategy will survive variation, but a fragile ones will need a perfection. Okay, so the minimum proof most traders skip is this, right? And basically what I mean is that here I'm going to show how to actually test a strategy. So the first thing, because I'm going to mention three key things that will help you, or the three minimum proofs most traders skip when they are actually testing a strategy. Number one is sample size matters. So 10 trades mean nothing. 20 trades will lie to you. So you need 100 trades under similar conditions. All right, you need at least 100 trades under similar condition. So that means 1 week isn't enough data. 1 month isn't proof. So you have to trade consistently under similar condition and look at least now 100 trades that you have executed. Okay, because most of the traders, what they do is that they do that first 10 trades and then they start looking at that to base their conclusions on that, which is very wrong. Not even 20, not even 30 trades will give you that, right? So you need at least 100 trades under similar condition. Okay, so the second, right, the second minimum proof most traders skip when actually testing a strategy is that that the issue of fixed rule. Okay, so I'll say it fixed rules only. That is, if you change rules mid test, the data is invalid. All right, so it has to be same setup, same risk, same session, and same pair. If you alter this in the mid of your testing, then it will invalidate the data, and what you'll get will be the false output. So you have to make sure when you're testing out a strategy, it is same setup, same risk, same session, same pair. If you can't keep rules stable, therefore you can't evaluate performance. All right, so the third aspect is to track expectancy and not emotion. Right, expectancy. How do we calculate expectancy? Expectancy is calculated by your win rate times your average win, then you minus loss rate times average loss. Okay, so if the number is positive, the strategy works. If it feels uncomfortable, even if it feels uncomfortable, okay. So I repeat again, the formula for expectancy is your win rate multiplied by average win, then you subtract loss rate multiplied by average loss. And I'm saying if this number is positive, the strategy works, even if it feels uncomfortable, because feelings are irrelevant. But mathematics, numbers, they are not irrelevant. They don't lie. Okay. They actually say, there is a phrase that says numbers don't lie. So How do you separate strategy failure from execution failure? Because again, this is another key problem that traders tend to mistake, right? So this is very critical, and listen to me well. This is where you need to ask yourself, did I follow my rules? Was risk consistent? Did I trade the right session? Did I journal execution errors? So if you broke the rules, the strategy didn't fail. You did. Okay. So the reason why you're asking yourself these questions is so that you can be able to differentiate whether it's the strategy that failed or maybe probably is the execution that failed, because the strategy can be perfect or it can be good, but the execution can fail you if you have a bad execution. So how do you differentiate that? You have to ask yourself these questions. Did I follow my rules? Was risk consistent? Did I trade the right sessions? Did I journal execution errors? Right. So because you realize that most bad strategies are actually poorly executed good ones, right? And execution comes before optimization. Why am I talking about this? Because I remember I used to abandon strategies right before they became profitable. I used to jump from one strategy to another. Today I hear about maybe probably support and resistance. I want to learn that. Tomorrow I see someone else talking about candlesticks patterns. I want to learn about that. The other day I hear someone talking about chart patterns. So I was hooping from one strategy to another. I didn't create that aspect of mastery. And the reason why in one of my videos I talked about power one, you give yourself a couple of time, like maybe probably 90 days to study one asset, to study one strategy and following one mentor. And the moment you have mastery, then you can now start looking at maybe probably understanding a different strategies, because there is no wrong in terms of trying to understand different strategies, but make sure you're not hooping from one strategy to another. Give yourself some time to study one strategy, to master one strategy. Okay. So, and the reason why I hopped from one strategy to another, abandoning this, jumping to another, is because I trusted short term pain over long term data. And once I committed to collecting enough trades, clarity replaced confusion. All right. So, in summation, what am I trying to say is that a strategy works if rules are fixed, right? So you're not um, changing your rules often, risk is controlled, expectancy is positive, sample size is sufficient. We have talked about at least 100 trades a sample size, and execution is consistent. So you don't need perfection, you need proof. As a trader, you need proof. There is no one who is 100% perfect, not even in trading, but in real life. Okay. So stop optimizing and start observing. That's how an hedge is discovered. Right. So in the next video, I'll talk about drawdowns and how to handle them psychologically and financially without destroying confidence or abandoning your plan. See you in the next one.